Αρχίζει σήμερα η προσπάθεια του Κώστα Kyamide να εξηγηθούν θέματα οικονομικής φύσεως που απασχολούν τον πολίτη. Πρώτος καλεσμένος είναι ο Clive Moore, ιδρυτής και διευθύνων σύμβουλος της IDAD, που έχει έδρα τη Βρετανία και ειδικεύεται στα δομημένα προϊόντα που έχουν πολλά πλεονεκτήματα. Η παρουσίαση είναι μόνο για πληροφόρηση και δεν αποτελεί πρόσκληση για επένδυση. Καλωσορίζουμε τον κύριο Moore, που ήλθε από το Λονδίνο ειδικά για τη συνέντευξη. Today marks the start of the effort of Kostas Kyamides to explain financial issues that are of interest to all citizens, starting with Clive Moore, who is the founder and managing director of IDAD, the specialist in structured notes that have many advantages. The presentation is designed to be for information only and does not constitute invitation to invest. We welcome Mr. Moore, who came from London in order to discuss the issues involved.
Γεια σας. Welcome to Kyamides Money Honey. The purpose of this program is to educate people on major financial issues. There will be a number of programs, and my first guest today is Clive Moore. Welcome, Clive, the owner and managing director of IDAD, a specialist in structured notes. The purpose of this is not to induce people to invest, is simply to inform people. Clive, please tell us about yourself.
Well, first of all, thank you very much for inviting me today. It's a pleasure to be here, and thank you for allowing me to speak in English. My Greek really isn't very good, so it's a pleasure to be here with you and with your audience. Yes, I've been working with structured notes and investments since the late 1980s. My first structured product was in 1992 when I worked at Citibank, so effectively 32 years specialising almost my whole career with structured products. Set IDAD up in 2002, so 22 years old now, and almost exclusively we work delivering structured investment products in the UK, in South Africa, throughout the rest of the world, both to ordinary investors but also to funds and institutions and professional investors as well. So yeah, that's my background.
And why did you go to structured notes and not shares or bonds?
Yeah, it's funny. I guess it was an early point in my career when I was at Citibank and we started working with structured notes. So up until that point, most of my career had been delivering and setting up and launching new investment funds, so traditional funds, investing in equities and shares, and or in bonds, so in debt instruments that banks were issuing, and working with insurance policies. But the real attraction for me of the structured notes and why I've spent most of my career here is just their ability to deliver more precisely the returns investors are after. So, I often imagine if you buy a fund investing in traditional shares or perhaps a combination of shares and bonds, there's a range of investment outcomes that are likely. So literally anything from losing all of your money or most of your money right through to making a 200 or 300% return over a period of years. But for a lot of investors, if you say to them, what is it you're hoping to achieve? For most investors, they're saying, well, ideally I don't want to lose any of my money, or I want to reduce the risk of losing my money, and I'd like to make a return of 8, 9, 10% a year. I'd be very happy with that. Now, some investors are much more adventurous. They want to make 15, 20, 30% a year, and are happy to take the risk that goes with that, so risk the chance of losing a lot of their money. But the joy of a structured product, a typical product, and we'll talk later about some of the different ideas, some of the different product shapes. A typical product might be linked, for example, to the S&P 500 index in the US, so a big, large index of shares. But the outcomes for investors will be either you'll get 8% a year after 2, 3, 4, 5 years, or you'll get all your money back. And then there's a very small probability if the index drops significantly, you'll get what the index drops by. Now, in doing that, we reduce the number of outcomes, but that increases the probability of getting that outcome. So investors won't get anywhere between 0 and 200%, they'll either get 8% or they'll get their money back, or there's a very small chance they'll lose money. So it's just a very efficient way of investing and actually delivers what investors want, I think.
Yes, in fact, one of the first things that impressed me with structured products is when I realized that if you invest today 100 on various indices,
Yeah.
and 3 years later the markets were falling and then they recover back to where they were,
Yeah.
with the structured notes you get not only your capital but you get your growth. Whereas had you invested in shares and they came back in 3 years, you simply got the amount you invested originally.
Yeah, that's right. And that's, it's easy for a lot of people who work in the investment industry to forget what it is people want. So a lot of people will offer a fund linked to shares, and their aim is to do as well as the next guy who's running a fund linked to some shares. And as long as they're outperforming him or not doing too badly, they're happy. But, you know, getting 1% a year and the next guy gets 0.5% a year isn't much use to an investor. You know, it's not delivering significant returns.
Yes.
So it's just trying to address what people want.
Yes, and I understand that premium banks are used to issue these structured notes, but you don't go direct to these banks. You need to go through what? Platforms of whose people? Platforms?
So yeah, that's the other area where I think, you know, we're really able to add value. So at IDAD we work with, I think, 42 different banks around the world. So all the household names are Goldman Sachs, the BNP, the Morgan Stanley, and what we're able to do is obtain the best prices, the best terms for clients by working with those banks. But effectively we act as an institutional investor. So, you know, if a client goes to Morgan Stanley or Goldman Sachs to buy a structured product, they might get shown to the private banking arm, you know, where the fees are quite high and they'll charge a lot of money and deliver the product. But what we do at IDAD is deliver almost from the factory gate. So we'll deliver a wholesale price. You know, we buy the products direct from the bank in large sizes, so we're getting the benefits of scale. And then those products are effectively broken down for individual investors. So, you know, an investor might buy, you know, $10, $20, $100,000 worth of a particular product, but we will be buying $5, $10, $15 million worth of that product and passing on those benefits to, you know, to the individual clients. So the terms wouldn't be available to individual investors, you know, because of the volume of business we do and the pricing we get. We're able to keep the costs, relatively low. So, you know, investors, as I say, they're getting a factory gate price for the product, and then there's a variety of ways they can buy that product and access it.
Yes. Can any nationality invest in these structured notes, or is not? You don't see them because you get the business from the administration of banks and insurance companies who themselves carry out the KYC.
Yeah. So we will never work directly with an investor. So the investor doesn't buy the product from IDAD. The investor will work with with a wealth manager or a financial advisor, and then who will look after all elements of their portfolio. So many of our investors will still have investments in funds or in deposits or more traditional investments, and then a portion, sometimes a very large proportion, will go into the structured products. The advisor and their investor will typically open a custody platform or an insurance bond, some means to be able to buy investments, and literally investors anywhere in the world will be able to open a facility, with their advisor, through which they're able to access the returns of the structured product. So in the case of an insurance company, for example, it's the insurance company that buys the product on behalf of the client, or if there's a platform. So what you won't see is IDAD structured products offered publicly to investors. So an investor can't come to IDAD and say, "Oh, I want to buy one of your structured products," and we won't offer them around the world. We'll always work through their financial advisor or through their wealth manager, and that affords us the comfort that the products are being explained to the clients appropriately, and also the wealth manager will be able to find an appropriate platform through which the clients can invest in the products.
And presumably there is a legal document constituting a structured note, and it's well regulated.
Enormously well regulated. So the investment a client is making is effectively linked to a it's the same as a traditional bond. So it's a contract, it's a promise issued by the bank. Goldman Sachs, for example, have a contract that whoever owns that asset, these are the terms they're going to get, and as long as the bank doesn't go bust, those are the terms the client will receive. And this is exactly the same terms as billions of dollars, sometimes trillions of dollars worth of investors, institutional investors who buy bonds from the bank. So literally, the terms offered are what will be delivered, and that's as good as the word of the bank. So mostly in most markets we'll work with what are known as systemically important banks or globally systemically important banks. So obviously they'll all have very strong credit ratings, but a lot of the bigger banks effectively have guarantees underwritten by governments and by central banks. And this is after the issue with Lehman Brothers, that some of the big banks are so critical to the operations of the world economy that they wouldn't be allowed to fail. So, often, pretty much all the products we'll sell, if investors lose money because the bank's gone bust, frankly, the world's got bigger problems to worry about than the investors losing a bit of money on that product.
But last year, the famous Credit Suisse collapsed.
Yes.
The structured notes, there were a lot of structured notes done by Credit Suisse. What happened? Did people lose their money, or did it simply change name to UBS, and why?
Yeah, and that's a perfect case in point. So the bonds or the structured products will have issued by the bank. So in the case of Credit Suisse, are issued as senior debt. So holders of that debt will be bailed out. So in the case of Credit Suisse and UBS, I know a lot of holders, institutional investors, bond holders, who were holding debt that was more junior, effectively lost out. But all the senior debt holders, which is where we'd always be,
yes,
absolutely fine with the products at all. So, and in fact, we're going through the process now where the guarantee is changing explicitly to UBS. So,
yes,
and that was a case of government intervention to make sure Credit Suisse didn't fail, and the investors, the bondholders in Credit Suisse, other than the people who bought the riskier bonds and the professionals who knew what they were doing, the bondholders haven't lost any money. They get exactly the same terms. In fact, most of them won't have noticed any difference at all.
Yes.
Yeah.
I think that is very important.
Yeah.
To know that your structured note is a senior debt on the balance sheet of a bank.
Yeah.
And we have the example of Credit Suisse, which proves that if you have a structured note with a famous bank that collapses, the one that takes it over continues. It's a senior debt.
Yeah, exactly that. So it's seamless for investors. And as I say, we do work with some banks where the credit rating is lower and the strength of the bank is less. And because of that, the returns available to investors are higher. Effectively, they're paying higher returns. But those banks we would only use for professional investors who understand the risk and are happy to take the higher risk on part of a fund, for example, in return for getting stronger growth or stronger income.
Yes, of course. I'm now trying to find difficulties for structured notes, and I'm envisaging in 2-3 years' time when the central bank digital currency scheme is complete, deposits will be transferred from the commercial banks to the central bank. What will happen to structured notes? How do they reconcile with the change in the banking system worldwide?
If anything, it should make life easier. So behind the scenes, it's like driving a car. Everyone knows how to change gear and indicate. How the engine works is a work of considerably complex science. And behind the structured notes, there's quite a lot goes on, and in terms of how the money moves, from the bank to the client. So moving to kind of digital currencies and better operational procedures just makes the products better value. So effectively, the process will work the same, but there should be less frictional cost. So the terms of the notes, it's not going to make a significant difference, but it should make no difference at all. I mean, even now, for example, we have investments linked to Bitcoin, linked to all sorts of assets. So actually moving to a digital currency will be a lot easier, and particularly for advisors and their clients when they're using particular platforms or using life companies to hold the assets. There should be easier and cheaper ways of them being able to access these products, which will make a lot of difference for people.
And what about the tax position? Each country has its own tax regulations, but I understand there is a difference between a pure auto call and a memory income. The one that you don't get the growth until you get your capital back, and the other one you get income as you go along. Are you facing any difficulties or any considerations what to do? Because structured notes can be bought anywhere in the world through their own banks. But each residency, each country has its own tax regulations. What is the position in the UK, for instance?
Yeah, so, and I wouldn't profess to be a tax expert, but we work in a number of jurisdictions around the world, and we try and develop investments that are suitable there. So, for example, in the UK, where we have growth products rather than ones that pay out income, we tend to have those structured so the returns are taxed. There's a different tax regime for growth on investments rather than income. In the international markets, most of our investors will hold their investments in a kind of non-domiciled local platform. So they might hold them in Luxembourg or in the Channel Islands or other jurisdictions. And the returns are paid out back into the insurance bond or back into the platform. The returns are paid out gross of any tax. And so it's for the advisors and the clients to, deal with the tax at a local level. But ordinarily that would only be when the money's brought back onshore into the country of residence. Yes. In simple terms, most of the growth products, if there's a tax regime where there's a different tax rate for growth, they will be taxed to growth. The investments are paid regular income, for example. If that income's brought back onshore, that would be taxed as income.
Would you say that the concept of investing in structured notes is catching up? You have 20 years plus experience in your own company. Is it catching up or is it dying out?
No, it's catching up. I mean, it was difficult. So after the financial crash in 2008, there was some loss of confidence, but more it was the fact that interest rates around the world really dropped off. So when I'm putting together a structured product, the level of interest rates, so the cash that investors would earn, on their money, the interest that they earn, has a significant effect on how much money can be spent delivering the payoff. So it's a combination on most products of the risk investors take, in terms of downside risk, where the barriers are, where their safety nets are, and the level of underlying interest rates. So since and we've been busy throughout that period, but since 2022, since interest rates have been going up, the returns on the products have got a lot better. So for investors, they're able to take much less risk and get a higher return, or just take a similar level of risk and get a higher return. And we're seeing a lot more investment in structured products. So a lot of investors, if you're a traditional equity investor and you look at a stock market index, some of them have done okay, and particularly in the US where you've seen strong growth in tech companies, but some of them have performed over longer periods, haven't delivered much growth. And so investors are a bit fed up with that. Since 2002, investors who were buying bonds or fixed income investments, principally because they thought they were more cautious investments and they didn't want to risk their capital, a lot of those guys lost a lot of money in 2022 and are looking for more efficient ways to achieve returns on their investment. So we've seen a big pickup, much more interest in products now.
So you have plans for the future to expand in the world?
You're
absolutely. So far registered in which countries?
So we're authorised in the UK, in Luxembourg, in the Isle of Man. We have a company in South Africa, so IDAD Africa, where we're authorised locally there, and working on a couple of other jurisdictions. But most, as I say, so the key thing for us and for investors and their advisors is because most of our business is done through international or offshore insurance companies or platforms, our authorisations we have at the moment are absolutely fine. And it gives investors the reassurance. I mean, the regulator in the UK is pretty strict. You know, there's a lot of reporting we have to do. You know, we're a very conscientious and careful company anyway. I mean, you get to the point where you've been running a business for 22 years, you're not going to risk everything for the sake of doing a bit of business. But yeah, so we're very, very heavily regulated. And as I say, you know, what we don't do is go to countries and put an advert in the local paper and say, "Dear Mrs. Jones, please feel free to buy this product." We always work through, through advisors. So Money Honey, for example,
Yes.
We'll work with professional, experienced advisors who can deliver the right product for their clients.
Yes. As an independent financial advisor, I know very well what you mean.
Yeah.
You always look for the best for your client by choosing around, because people don't know as much as one who's in the business knows, so you have to protect them. Well, I could be asking you questions forever, but I think it's only fair to ask you, you want to say something that I missed out in the questions?
I think the key thing here is, although under the surface the construction of the structured products can be quite complex, for pretty much all investors, the terms are very simple, and people get confused, because it's a structured product and they're not used to it. Effectively, it's a contract issued by a big mainstream bank. The bank promises to pay X as long as Y happens, and the terms, we try and keep the terms of the products as simple as we can. We'll introduce new features from time to time where we think they're appropriate for investors. But I always think, once the end client actually reads through the terms of the product and works with their advisor to understand them, actually they're refreshingly simple. And perhaps the biggest thing for me, we see, I think there's only one firm of advisors we don't deal with after 20 years. So basically, when we start working with advisors and their clients, we never stop. We continue. We have the clients reinvest continually. They're happy with the returns of the products. We've made a lot of people a lot of money, and saved them from losing money. So I think that's probably the biggest thing is, once investors get used to structured products and understand them, and as I say, people don't have to put their whole pension into one structured product on day one. But once people understand them, the benefits are clear and they tend to deliver. We have had very few, but a few products where investors have lost some money, which obviously we'd prefer didn't happen. But again, if investors are looking for a 20 or 25% a year return, the risks are significantly higher. But we're very happy with how we've served investors and their advisors.
Now you are provoking me to ask you one more question.
Okay.
In the UK, you have the famous expression "one for the road." In the European Union, we don't have that.
Okay.
And the question is, there is a difference between using indices rather than companies.
Yes.
What is the difference?
Well, the structured products, the returns available and the shape of the product, it can be infinite. So, for example, a lot of the products we do will be linked to mainstream stock market indices that advisors and their investors can follow. They understand it. If the Tokyo stock market has dropped 50%, not surprisingly, the value of their investment might have dropped 50% as well. Most of our investments, we're looking not for the markets to grow, just to not fall, or sometimes just not to fall by too much. But with the major stock markets, the risk is less. So generally, the returns will be less. You might get 8 to 10% a year. For some investors, they're looking for higher returns, perhaps younger investors investing a smaller portion of their portfolio. And then we would use individual stocks. So, we've done some products, for example, which are probably a lot less risky, where they're linked to the value of shares in banks. But by the same token, we've done products linked to the shares in tech companies, Tesla and Nvidia and so on. And where the stocks are more volatile and they go up and down a lot more, the returns available will be higher, but the risk will be higher as well. So we'll try and put more protection in. But there's no secret, even with structured products, the higher the return, the higher the risk. And the only other thing I'd say is, we see all of the products we do tend to have fixed lives. So it might be a 2-year product or up to 6 years. Often most of the features will allow them to finish early and deliver the returns early. But even for investors who are buying a 6-year product, all of the products, this is debt issued by the world's biggest banks. They will always make a market in those products. So if people need to access money, a daughter's wedding, or they need, or they've died, or need to raise some cash. All of the products are priced during every day. So at any point, if markets aren't doing well and the price not be as good as you might hope, or the price might be better, but people can access the value at any point. It's very simple to sell out of the products early. The same terms won't apply, but for investors who are worried that they really are tying their money up for 6 years, that's not the case. They can always access that.
I see. Okay.
Something for everyone, Costas.
Yes. Okay. I would like to thank you for being the first guest in this program, which is designed to educate people on financial matters. I hope you don't mind that you be going around the world, because the idea is to all Greeks around the world through adverts will be watching this program, and I hope you don't get lumbered with too much business, but this is for information purposes only. This is not an invitation to invest. Thank you very much for being my first guest, Clive.
Well, thank you for inviting me. It's been a pleasure and very enjoyable. And ευχαριστώ.
Παρακαλώ.